Those are some of the issues to dominate the agenda in the coming week. What's dominating the world stage right now is sovereign debt issues in Europe, quantitative easing, a third round in the United States, and prospects for growth in Africa. The IMF has released a report that's going to be looking at Sub-Saharan Africa and the outlook for growth. We're now joined by Abebe Aemro Selassie, Assistant Director for Africa at the International Monetary Fund. Thanks so much for coming through.
Thank you.
Let's start off with the general global picture and where we're at, because the sovereign debt overhang has had repercussions for most emerging market economies that still need Europe and the United States to consume their products. We're not seeing that, investors holding back. What does that mean for the immediate and the near term?
Well, our concern clearly is basically the sovereign debt problems that we're seeing in Europe are going to have the effect of slowing the global economy down. Our baseline forecast in October was for the global economy to expand by 4% this year and about the same for next year. That now looks a little bit optimistic. We're in the process of revising our numbers and we'll be coming up with new forecasts. But the concern really is that growth will be slower than we had earlier envisaged.
And obviously what we see when growth is slowed is people become risk averse and emerging markets are seen as very risky. That's definitely had a repercussion for South Africa, for instance, where we've seen a pullback from South African bonds, largely because this market is the most exposed internationally. Your forecast for growth in South Africa, because the sense is it's just going to be subdued and sluggish.
Yes, well, there are two factors that have caused us to revise our growth forecast for South Africa down from around 3.5% earlier in the year to 3%. The first of these is the global economic outlook. Basically, growth is expected to be lower. So that's, as you said, South Africa is a very integrated economy into the global economy. So that's going to have an effect on South Africa. But another factor is a more domestic factor. Basically, you had disruptions to economic activity in the second quarter, some in the third quarter also. In the second quarter, as a result of the tsunami in Japan, which had knock-on effects on the supply chain, including to South Africa. And of course, in the third quarter, you had some strikes disrupting activity.
Action. The issue is South Africa really needs to push up productivity to over 6% in order, national output to 6%, in order for us to generate jobs. It's a very sensitive social issue, this unemployment. And unless we see growth coming up beyond 6%, we've got major problems. Your views on just the structure of this economy and what could be done to make it better?
So we share those concerns on employment very much. I think the government's assessment in the national growth plan, the new growth path, that you need growth of 5-6% to generate 500,000 jobs a year is spot on. So you really need two things right now. With growth more likely to be in the 3% range, what has to happen if 6% is not possible, then the 3-4% growth that you're going to get has to be made more labor intensive. What does that require? That will require a number of reforms. Our view at the IMF is that the labor market is fairly flexible in the volume dimension. So, people coming in and out of the labor force is not the issue. But on the wage dimension, you don't have as much flexibility. And wages need to be growing in line with productivity. But in the last couple of years, what we've seen is wages growing ahead of productivity increases. So better alignment of wages with productivity are among the policies that the government has to look at.
It seems a different picture for Sub-Saharan Africa, because there we're expecting buoyant growth. I mean, just today we got figures of 10% for Angola, over 7% for Nigeria, near 7% for economies like Zambia. Is it because they're coming off a low base? Is it because commodities are going to continue to demonstrate very good prices in the next year?
I think you've touched on a couple of the issues. So in most of the rest of Sub-Saharan Africa, we are expecting growth to recover to pre-crisis levels. And higher commodity prices have played a role. But really, our sense is the bigger factor is the investment that's been taking place, the reforms that countries had put in place over the last many years, beginning to bear fruit. And one of the most interesting things we noticed in 2008-9 when the global financial crisis hit Sub-Saharan African countries was they adopted fairly expansionary policies. In the past, they typically tended to follow contractionary policies when they faced by a crisis. This time, governments were able to put in place expansionary policies, keeping growth going.
I find that ironic that a senior IMF executive is sitting here saying we're smiling about expansionary policies, because often you preach the message of restraint, that you can't grow just by having excessive government spending. It creates problems in the long term, huge deficits, inflationary problems as well. And we're starting to see inflation tick up.
Well, there's a time and a place for everything, right? So in the good years, countries need to basically follow what we call counter-cyclical policies. So restraining spending in the good years to save up a buffer. Yeah. And of course, when you're hit by a shock, that's the time to begin utilizing those shocks, which is what countries in much of Africa were able to do this time round. So that's the reason for our policies. You mentioned inflation rising at the moment in several countries, the Kenya numbers you mentioned earlier. That, by and large, has to do with exogenous shocks. So food and fuel prices were higher last year. That is, being felt in many countries. So one of the things we're concerned about, overlaying this very strong growth story, is actually the displacement and dislocation that we expect inflation to have, particularly on the urban poor in many countries.
When the worst of the credit issues were pervasive, 2008, 2009, we were told that Africa was immunized because we didn't have integrated economies. This time, when we're talking about possibly a double dip, we're told that we shouldn't rest on our laurels, that this time Africa is exposed. On the investment side and FDIs that you've spoken about, we're seeing currencies quite volatile, shocks to fluctuating commodity issues. How safe is Africa at this stage?
Well, so that is the concern that we have, that while the growth outcomes in 2011 in particular are said to be very robust, going forward as the global economy slows, we are concerned that there will be an effect on Sub-Saharan Africa. And the concern also is that a lot of the room, the policy buffers that the countries had were utilized to combat the last crisis. So buffers are going to be narrower, smaller than going forward for this crisis. This said, we're hopeful that with the pursuit of the right policies, countries will be able to, manage the hit that's going to come from a slowdown in global economic activity.